Let me introduce to you investor A, who is somebody like me and you, who's put his money in a debt product for a period of 5 years. He earns his interest every year, pays off his taxes. At the end of the 5th year, is left with a corpus of 125. Similarly, there's another investor B who also wants to put his money into a debt product for the same tenure of 5 years. The product is slightly different, but the risk exposure in terms of the ratings of both the products are very similar. So he also puts his money in a debt product for 5 years. At the end of 5 years, he lands up with a corpus after paying off all the taxes of 136. You may wonder, how is that investor B investing in similar products as investor A with the similar risk profile? How is he landing up with a corpus which is 10% higher than investor A? Well, the mystery can be solved once you understand taxes. Hi, my name is Harshvardhan Dawar and I am from Wealth Cafe, where we share with you ideas to help you make smart investing decisions. I have not met till today a single person who is happy to pay taxes more than that is due based on the prevalent laws and after taking into account the maximum tax planning that is possible within the purview of law. Everybody would like to minimize the amount of taxes they pay and optimize their portfolio returns, and that's what we're going to talk about when we look at investor A and investor B's portfolio. Investor A went and parked his money in the traditional fixed deposits, which is the most common product and most popular product actually in India. So when you put your money in a fixed deposit, what happens is he's put his money in a fixed deposit that earns him 7% every year. Every year, since he's in the highest tax bracket, he discharges his taxes at the rate of 35%, and what is left in his pocket is a measly return of 4.55%. And every year he can reinvest that 4.55%. At the end of 5 years, you will get a corpus of close to about 125 from investing in a fixed deposit. What is happening here is he is earning an interest income every year. That interest income is chargeable to tax the year he accrues it, and he has to pay off the taxes to the government. What is left is what he is available to the investor to reinvest and grow his portfolio. Now, what does investor B do? He is a slightly smarter investor. So what he does is he puts that 100 rupees not in a fixed deposit but instead in a debt mutual fund. The debt mutual fund in turn invests the money in various deposit earning instruments, whether they are G-Secs, whether they are debentures, whether they are deposits, any of those instruments or a combination of them rather. And every year, whatever return that investor B makes, he does not pay any taxes on it. Why? Because he has not sold that mutual fund. Although he's earning a return, the return is accruing to him in the form of what is known as capital gains, and as per the law, as per taxation laws, he's supposed to pay taxes on those capital gains only when he sells the product, not when he earns the income. So he's earning the income here, he's not paying any taxes. So assuming that he's earning the same 7%, he's actually not having to pay any taxes. The entire 7 rupees is getting reinvested every year, and he's able to grow his corpus at a faster rate because taxes are not eating away his returns. His money is invested, and as time passes, by the end of 5 years, he decides that okay, it's time, I need the money, I will sell the investment, and he decides to go and sell it. He will have to pay a tax bill on the entire earnings that he makes at one go, right? But he's had an advantage till now. And what was the advantage? He was able to grow his corpus to a larger size because taxes were not being eaten away from his portfolio. The taxes remained, which investor A paid off. Here they remained invested in the portfolio for B, and he was able to grow his corpus to a larger amount. Well, that was the first benefit or first advantage he had. And the second advantage is, since he stayed invested for a period more than 3 years, he is now going to be taxed as what is known as long-term capital gains, and as a result of which he's going to be taxed at a lower rate. And what is that rate? That rate is 20%. So versus the 35% investor A paid here, investor B is going to pay a tax rate of only 20%. And not only that, the cherry on the cake is he's going to enjoy the benefit of indexation or the benefit of inflation. So what the government says is, if the inflation is on an average every year, say 5%, the government says that whatever return that you earned, you take a deduction for the inflation that ate into your returns, and the balance that is left, you pay taxes on that. So not only you pay taxes on a lower amount of returns here, the tax rate also is lower to 20% versus a 35% tax rate here. So you can say that just by being a little smarter and changing the product where he's investing, changing your cash flow, which is interest income here, to capital gains income here, he is not only able to save on taxes, but also he is able to reduce the tax amount he needs to pay, the tax rate he needs to pay, just by changing the instrument he is investing in. At the end of the 5-year period, investor A will land up with a corpus of close to 125 and investor B will land up with a corpus of 136 if they both choose to invest in products of similar risk profiles. So investor B is able to earn a 10% excess return just by saving on taxes. And that is what you must look at as an investor, wherein you want to maximize the returns you can get from a certain risk you're taking by cutting down the taxes. One caveat you must be aware of here is that when you put your money in debt mutual funds, you are not assured a return. You are not assured a certain fixed return like fixed deposit. But after you take into account the fact that my tax rate is lower here by 20%, and also the fact that I am going to be taxed at a much smaller amount of capital gains because I get the benefit of inflation and indexation, even if I don't make 7% returns from my debt mutual funds, I make say 6.5%. After taxes, I am going to be better off when I'm investing in a debt mutual fund than investing in a fixed deposit. This strategy works really well for people who are in the highest tax bracket, that is 30-35% after adding for surcharge, and also works really well for those who have a large amount of fixed deposit in their portfolio which are constantly being renewed year after year because they continue to stay a part of your debt portfolio. You can consider moving that to the debt mutual funds because there you earn better post-tax returns compared to what you earn from investing in a fixed deposit. If you're wondering how this strategy can work for you, or if you have any questions regarding this, either leave them in the comment section below or do feel free to reach out to us. We as a team of registered investment advisors and chartered accountants are well positioned to help you how you can minimize your taxes for the same returns that you're getting without increasing the risk of your portfolio and maximize your post-tax returns, because that is the number that matters more than looking at the returns, that is the pre-tax returns which a certain investment gives you. Do like, share and subscribe to our channel so that you continue to receive such smart investing ideas every Wednesday and Saturday.